Assalamualaikum, my name is Muhammad Mirza Haziq. So today our group have choose PCG. So what is PCG? PCG is Petronas Chemicals Group Berhad. It's a leading integrated chemicals producer in Malaysia and Southeast Asia. Established in 1985, PCG operates a diverse portfolio of chemical products including olefins, polyolefins, fertilizers, methanol and other basic chemicals. As a subsidiary of Petronas, Malaysia's national oil and gas company, PCG leverage integrated operation and a robust supply chain to serve global markets. So next, we move to sector classification. PCG operates in the chemical industry classified under the basic material sector. This sector includes companies involved in the discovery, development and processing of raw materials critical to various industries such as manufacturing, agriculture and construction.
Petronas Chemical Group Berhad (PCG) disclose information about their property, plant and equipment (PPE) in accordance with the applicable financial reporting standards. Typically, International Financial Reporting (IFRS) or Malaysian Financial Reporting Standard (MFRS). The specific details can be found in their annual reports and financial statements, which provide comprehensive information about the type of PPE, their recognition criteria and initial measurement. Type of PPE. PCG disclose the various categories of PPE they hold, which may include land and buildings. These are properties owned by the company including office, factories and other facilities. Next, plant and equipment. This includes machinery, tools and other equipment used in the production process. Next is furniture and fittings. Office furniture and other features that are part of the company assets. Vehicles. Company-owned vehicles used for transportation and other operational needs. The last one is capital work in progress. Assets that are under construction and not yet ready to use. Recognition of property, plant and equipment (PPE). Recognition criteria. PPE are recognized when it is probable that future economic benefit will flow to the company. The cost of the asset can be measured reliably. Initial measurement. PPE is initially measured at cost, which includes purchase price, import duties, non-refundable tax and any cost directly attributable to bringing the asset to the location and condition necessary for it to be used as intended. This approach ensures that PPE is recorded on the balance sheet at a value that reflects its acquisition and preparation for productive use, aligning with financial reporting standards for clarity and transparency.
What is subsequent measurement? Subsequent measurement is the process of updating the value of an asset or liability after its initial recognition on the balance sheet. This ensures that the financial statements reflect a more accurate and current value of the asset or liability over time. Subsequent measurement can involve changes in the asset's value due to depreciation, amortization, impairment, revaluation, or other factors that affect its worth. There are two reasons. First, simplicity and the last one, consistency. What is depreciation? Depreciation is an accounting method that allocates the cost of intangible asset over its useful life. Businesses use depreciation to account for the gradual wear and tear, decay or reduction in value of an asset over time. This method ensures that the expense of using an asset is matched with the revenue it generates in accordance with the matching principle in accounting. PCG adopts the straight line method for depreciating its property, plant and equipment. This method allocates the depreciable amount of an asset evenly over its useful life. For useful life, building 20 to 50 years, vehicle 5 to 10 years, plant and machinery 10 to 20 years, and the last one, office equipment 5 to 10 years.
Gross profit margin is a type of accounting ratio that helps in determining the financial performance of businesses at the end of an accounting period. So what is the gross profit margin formula? So gross profit margin formula is gross profit divided by revenue. So gross profit for 2021 is 8,578 divided by 23,025 multiplied by 100%, we got 37.26%. Gross profit for 2022 we got 8,676 divided by 28,953 multiplied by 100%, we got 39.97%. Gross profit for 2023 we got 4,785 divided by 28,667 multiplied by 100%, we got 16.69%. Return on asset or ROA is a financial ratio that measures the profitability of a company in relation to its total asset. So what is ROA formula? So the formula is net income divided by total assets. So ROA for 2021 we got 7,319 divided by 46,608 multiplied by 100%, we got 15.07%. So ROA for 2021 we got 6,437 divided by 55,430 multiplied by 100%, we got 11.41%. So ROA for 2023 we got 1,750 divided by 60,206 multiplied by 100%, we got 2.91%. As you can see, the graph for gross profit margin over the 3-year period from 2021 to 2023, there is a clear downward trend in the metric being analyzed. In 2021, the percentage was 37.36%. This decreased to 29.97% in 2022, indicating a significant decline. The trend continued in 2023, where the percentage further dropped to 16.69%. The consistent year-on-year decrease highlights a significant reduction in the ratio over the 3 years. The graph for return on asset from 2021 to 2023 shows a marked decline in the percentage values. In 2021, the percentage was 15.07%. This decreased to 11.41% in 2022, indicating a notable drop. The trend continued in 2023 with the percentage plummeting to 2.91%. The graph visually represents this consistent downward trend over the 3 years.
Next, I want to give the second ratio analysis. It was a liquidity ratio. A liquidity ratio is a financial metric used to evaluate a company's ability to meet its short-term obligation using its most liquid asset. It has various ways to calculate, such as current ratio and cash ratio. For the current ratio, the meaning for current ratio is that measures a company's ability to pay off its short-term liability with its short-term asset. How to calculate the current ratio? For the current ratio, it must have current asset and current liability. Current asset must divide by current liability. For this company, the current ratio for 2021 it was 4.33 ratio 1, while for the 2022 the current ratio was 2.46 ratio 1. The last year for 2023, the current ratio this company was 1.89 ratio 1. Second, for the liquidity ratio, it was a cash ratio. Cash ratio is a measure of company ability to pay off its short-term liability with its most liquid asset. How to calculate the cash ratio? For the cash ratio, it must have a cash and cash equivalent divided by current liability. For this company, the cash ratio for 2021 was 3.31 ratio 1, while for the 2022, the cash ratio is 1.37 ratio 1. The last year, it was 2023. The cash ratio is 1.04 ratio 1. Firstly, I want to give a little explanation about the liquidity ratio. For the liquidity ratio, current ratio. For the you can see the graph. The graph go downward from 2021 until 2023. The ratio was more than 1. It means the current asset more than current liability. The excellent year for the current ratio was 2021. Why? For the cash ratio, it also same as the current asset. Current ratio is go downward for, from 2021 until 2023. The ratio also more than 1. It means the company ability to pay off short-term liability with cash and cash equivalent. The excellent year for the cash ratio is also for the 2021.
Efficiency ratio is to measure how efficiently a company uses its asset to generate revenue and its liability to manage those assets. There are two things in efficiency ratio. They are inventory turnover and assets turnover. Inventory turnover is the rate that inventory stock is sold or used and replaced. The formula is cost of goods sold over average inventory. For this company, the inventory turnover is in 2021 is 7.19 times, 2022 is 7.14 times, and 2023 is 6.6 times. Asset turnover is to measure the efficiency with which a company uses its assets to produce sales. The formula is net sales over average total asset. Asset turnover of this company is in 2021 is 0.53 times, 2022 is 0.57 times, and 2023 is 0.5 times. I want to explain the efficiency ratio graphs. Inventory turnover graph show that increasing in 2022 from 2021 and decreasing in 2023. This is because overstocking or inefficient sales. The graph for asset turnover show that increasing in 2022 from 2021 and decreasing in 2023. And this is because obsolete inventory or sluggish sales. Solvency ratio measure how well a company's cash flow can over its long-term debt. Debt ratio is a financial ratio that measures the extent of a company leverage. The formula is total liabilities over total asset. The debt ratio of this company in 2021 is 0.24, 2022 is 0.28, and 2023 is 0.3. The equity ratio is a financial ratio indicating the relative proportion of equity used to finance a company's assets. The formula is total equity over total asset. The equity ratio for this company in 2021 is 0.76, 2022 is 0.72, and 2023 is 0.7. Next, I want to explain the solvency ratio graph. They are increasing in debit ratio graph from year to year. This is because the business has taken on a large amount of risk. They are decreasing in equity ratio graph from year to year, and this is because the company primarily used debt to acquire asset.
Conclusion: Petronas Chemical Group Berhad (PCG) is a leading integrated chemical producer in Malaysia and Southeast Asia. Benefiting from its association with Petronas, over the past 3 years, PCG has demonstrated financial resilience and effective management. Profitability. Gross profit margin and return on asset show fluctuation due to market condition, but generally recovered by 2023. Liquidity. Strong liquidity was maintained with current and cash ratio reflecting the company's ability to manage short-term obligation. Of efficiency. Stable inventory and asset turnover ratio indicate efficient operations. Solvency, low debt and high equity ratio highlight a strong financial foundation with minimal reliance on debt. Overall, PCG financial health and strategic management position it well for sustained growth and stability.